Netflix just released its first quarter 2026 earnings report, and the stock is taking a massive hit in the after hours market. Whenever a mega cap tech stock drops like this immediately after earnings, retail investors start to panic. They see the red on their screens, they read the sensational headlines, and they hit the sell button. But focused investors should do exactly the opposite. They look at the raw data, block out the emotional noise, and look for buying opportunities when elite businesses go on sale. In this video, I am going to break down exactly what happened in the Netflix earnings report today, why Wall Street is reacting so negatively to the numbers, and most importantly, why I'm planning to use this exact crash to buy more shares and aggressively add to my position. Welcome back to Rebuild Finance. This channel is about documenting a real journey to a $1 million portfolio. If you want to see exactly how I trade these market events without letting fear dictate my decisions, make sure to subscribe. Let's strip away the drama and look at the actual numbers. If you just looked at the main headlines today, you would be incredibly confused as to why Netflix is dropping. The headline numbers actually looked fantastic. Wall Street was expecting an earnings per share of around 76 cents. Netflix just reported a massive $1.23 per share. They completely crushed the profitability estimates. They reported $12.25 billion in revenue, which beat expectations and represents a strong 16% growth year over year. So if they beat expectations on both the top and bottom lines, why is the stock bleeding? Because Wall Street institutions know how to read the footnotes in a balance sheet. That massive profit beat did not come from a sudden, magical explosion of new streaming subscribers. It came from a massive one-time accounting event. If you have been following this channel, I made a video a few months ago talking about Netflix and Warner Brothers. For months, Wall Street was convinced that Netflix was going to buy Warner Brothers Discovery for over $80 billion. I warned that taking on that massive debt load could destroy the company. But Netflix management showed extreme financial discipline and walked away from the deal. Because that mega acquisition officially collapsed, Netflix was owed a massive breakup fee. A big part of that earnings beat came from a $2.8 billion termination fee related to the collapsed Warner transaction, and Netflix recorded that gain in interest and other income. So the issue is not that the quarter was bad. The issue is that the headline earnings beat was helped by a one-time gain, which makes the beat look stronger than the underlying business really was. It was a good, solid quarter, but it was not the massive fundamental blowout that the headline EPS number suggested. But the main reason the stock is dropping tonight is simple. Second quarter guidance came in below Wall Street expectations, while the Reed Hastings news added even more uncertainty to the reaction. The stock market is a forward-looking mechanism. It does not care about what you did yesterday. It only cares about what you're going to do tomorrow. And Netflix's management just gave a very cautious outlook for the second quarter of 2026. Wall Street wanted to see aggressive growth forecasts. They wanted to hear that the new advertising tier was going to double in size tomorrow. But Netflix management was honest and warned that subscriber growth might slow down in the coming months, especially now that the password sharing crackdown has mostly played out. And then they dropped the bombshell. Reed Hastings, the legendary founder and chairman who built Netflix from a DVD rental service into the absolute undisputed king of global streaming, announced he will officially step down in June. When you combine slowing subscriber growth guidance with the sudden departure of a visionary founder, institutional investors get nervous. Wall Street absolutely hates uncertainty. When algorithms and hedge funds see uncertainty, they hit the sell button first and ask questions later. And this is exactly where the opportunity is created for long-term investors like us. I believe the market is completely overreacting to short-term news, and they are completely ignoring the long-term fundamentals of the business. Let's look at why I am so incredibly bullish on this company, even with Reed Hastings leaving. First of all, Netflix is no longer burning cash to survive. For years, the bears criticized Netflix for burning billions of dollars to fund their content treadmill. Those days are officially over. As I highlighted in my previous videos, Netflix is now a free cash flow machine. In 2025, they generated nearly $9.5 billion in free cash flow. They have a pristine balance sheet with highly manageable debt. Because they refuse to overpay for Warner Brothers, they have total optionality with their cash. What are they doing with that cash? They are pivoting hard into live sports. They secured the rights for WWE Raw and NFL games. These live events bring massive, guaranteed viewership and allow Netflix to charge an absolute premium to advertisers. Second, let's talk about their operating leverage. From 2023 to 2025, their gross margin jumped from 41.5% to 48.5%. In a digital business, once you cover your fixed costs, like server infrastructure and the initial production of a TV show, every single new subscriber you add drops pure profit to the bottom line. They'll officially have over 325 million paying subscribers globally. If you assume 2 or 3 people share a household, Netflix is regularly watched by almost 1 billion people. No other platform on planet Earth comes close to this distribution scale. Because they are the default entertainment app in millions of homes, they have immense pricing power. They can slowly raise prices by $1 or $2 a month, and people simply accept it. You cannot easily cancel Netflix. It has become a staple of modern life. This kind of dependency creates an incredibly powerful long-term economic moat. And finally, they do not have to burn cash to catch up to their competitors. Companies like Disney and Paramount are losing billions trying to build streaming platforms. Netflix has already won the streaming wars. The war is over. Now, it is just about maximizing the profits. If the stock continues to drop over the next few days, or if it stays at these depressed levels, I am treating this as a massive gift. I'm going to use this weakness to buy more shares and add to my existing Netflix position. When you want to build a $1 million portfolio, you do not buy elite companies when they are hitting all-time highs and everyone is greedy. You buy them when the market is throwing a temporary tantrum over a cautious quarterly earnings report. Yes, Reed Hastings is stepping down, but the company has a massive established leadership team that has been running the day-to-day operations for years. The foundation is already built. So my takeaway is not that this was a bad quarter. My takeaway is that this was a good quarter with low quality earnings and underwhelming short-term guidance. And that distinction matters because those are two very different problems for long-term investors. The binary risk of a massive, stupid acquisition is gone. The company is leaner, smarter, and incredibly profitable. Now, I want to hear from you. Are you buying the dip on Netflix right now? Or do you think the departure of Reed Hastings and the weak guidance at the beginning of 2026 means the stock has further to fall? Let me know down in the comments below. I read and respond to all the comments. If you found this breakdown helpful, please hit the like button. It really helps the algorithm push this video to more investors. And if you want to follow my exact journey as I build a portfolio to $1 million, make sure to subscribe. Thanks for watching, and I will see you in the next one.